So what are the factors, the key factors there that differentiate from the rest of the asset classes, and how you think is more beneficial?
So, for me, it's not one or the other. That's why we do both. But
Mhm.
it's a great hedge to have a balanced portfolio with student housing exposure. So, student housing is typically recession resistant. If there's a softness in the economy, people go back to school or they stay in school longer because there's not as many jobs.
Mhm.
Uh, and in 2008 and 9 were phenomenal record years for student housing. Um, During COVID, in fact, student housing grew as an asset class. We realized that students didn't want to be in their parents' basement studying virtually. They actually stayed on campus during housing and continued to pay rent.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba, a commercial real estate investor. And today I have a very special guest, my very good friend, Alix Kogan, with me. Welcome, Alex, to my show, The Real Estate Vibe.
Hi, Vinki. Good to be here.
Thanks for being with me today. A little bit about Alex. Alex has been a successful real estate developer for 20 years. He founded a high-end construction and development company in Colorado that grew to become one of the largest and most successful firms in Southwest Colorado. Today, Alex focuses full-time on growing his private equity real estate firm, Ashland Capital, which partners with accredited investors to purchase cash-flowing multifamily and student housing assets. With a broad-based knowledge of multi-real estate classes, Alex currently owns 2,500 apartments and 1,500 student housing beds. In 2017, Alex and his family returned to their hometown, Chicago, where he enjoys being involved in community with sports, philanthropy, and family while raising his 7-year-old son with his wife. Welcome again, Alex. I'm super excited to have you with me today. So today our topic is going to be how to vet a sponsor, or what should LPs look for in a sponsor. So Alex has so much knowledge. He's the powerhouse of knowledge. So he's going to share his journey with us. So let's start with that first. Alex, can you tell us a little bit about your background, how you started and how did you get here?
Sure, I'd be happy to. So, I think, the most relevant background is my family are builders, developers, and have been in real estate and real estate development for a long time. And when I was in my 20s, I wanted nothing to do with that business. I was definitely going to be the black sheep that would do something different. And of course, in my 20s, I was young, dumb, and romantic and wanted to do different things and save the world. And I'm glad I had those experiences. But my first, real job, so to speak, was being a teacher. And I was a high school teacher, taught business and history. And it was really through that experience that I realized, number one, I was making no money, and it wasn't exactly what I thought it was going to be. And it allowed me to pivot and decide to go back into my family roots and family business. Although I didn't go into the family business, I decided to get into real estate development and construction, and that's really how I started, which was late in '98. I left Chicago, moved out west, started my company, and we did the first major vertical of the company was a high-end design build company. So we built luxury multi-million-dollar homes, designed and built them. I had a team of designers, architects, whole construction crew, fully vertically integrated. And we had a great run over 20 years and built a great company, did amazing projects. So really enjoyed that. And then simultaneously, within the first year or two, we started a development arm and we started building small multifamily infill projects. We did subdivisions, we did land entitlement, we did some mixed use, some commercial. So really touched a variety of asset classes as a developer. So that was the second vertical of the company. And then the last piece, which is really what has evolved into Ashland Capitals, I always bought real estate. I've always bought, back then we called them college rentals. So single family, duplexes, triplexes, small multifamily that were rented to college students. And then all other kinds of rental, not necessarily college students. So I did that and bought a bunch of properties over 20 years. So my sort of growth and progression has been much slower when you look at, some of the syndicators today that, went from 0 to 60 in 2 years and left their corporate job. And, my story was much more, I think, gradual and conservative in terms of the way that I got to where I am today. But that's okay. That was really, I never wanted to get over my skis and grow too fast and be out of control, and pretty conservative investor when it comes to that. So in the big transition was in 2017. We moved back to Chicago to raise our son close to family, and I sold right around that time. I sold my construction company, development company. I sold the entire portfolio because it was scattered site, and it was a bunch of small assets, and we self-managed, which became a huge bottleneck and huge pain to manage that type of portfolio. And naturally started buying larger institutional assets around the country, both purpose-built student housing, not single family, as well as, of course, conventional multifamily. And that's been sort of the evolution for the last 4 or 5 years of what Ashland Capital became from my early roots of doing all the other, real estate, construction, development activities. I know that's a mouthful, but that's that's the background.
No, I think that's a really interesting background and very, very well paced and well planned. So one question that sticks to my mind is like you were a high school teacher, history and business, right? That's what you said?
That's right.
And how did you come to real estate? What made you decide that you wanted to go and start a design company in real estate? I mean, there's no correlation, and a lot of people, they don't do that. They're scared, like, oh my God, I'm in this genre. I don't want it to change, or how could I do that? So that's a total mindset shift there.
Well, I mean, in fairness, the real estate construction development business is what I grew up in. So my father was a developer. My brother is still. So I grew up around that business and knew it, and had short stints of working with them for a little bit. Pivoting into teaching high school was the departure, and that only took a couple of years to get that out of my system, and and realized that I shouldn't run away from my roots. I think that was just when you're young, you want to do something different. You don't want to just do what your family has done. You want to kind of forge your own path. But ultimately, I realized my passion is real estate. My passion is construction, it's design, it's investments. That's all I saw with my family. My family are entrepreneurs. They never had sort of a corporate job. They never worked for anybody else. They've always been entrepreneurs and worked for themselves. So finally, I had to go through that experience to remind me that that's a great thing to do, to be in charge of your own destiny. And it is my passion. I love buildings. I love real estate. I love construction. I love it all. And that's how I ended up, going back to it, so to speak.
So it was in your DNA. So it was coming back home kind of. So you're trying to separate yourself, but that was the destiny. I love it. So you've been in the land development to design and land development. So how do you see those are different than this student housing that you're doing? Those are the existing ones, I assume. And even the multifamily space too, you're getting the existing one. Because I know I was on one deal with you, which did pretty awesome. And we completed in 17 months, gave good returns to investors.
Yeah, it was great to partner with you. I mean, that was a great deal. And, as you know, we returned almost 40% to our investors. So, that's a different risk profile. That's a good segue into sort of, looking at land development or multifamily development versus student housing and multifamily acquisitions. And I would say there's certainly more risk with development. We are not doing any development right now. That was my previous life. and I'm much more conservative today. So right now we're focused on just buying existing assets. At some point, of course, because it's in my DNA, I may get back to it. Everybody is always bringing me a project. Hey, let's build this, let's build that. And, while I have other opportunities to acquire and take less risk, I'm doing more of that, but you never know. So in terms of multifamily, I mean, I'm not going to tell you anything that you don't know. I think it's a great asset class. We have the fundamentals are still very good as long as you're buying in the right market, you're buying the right asset, and you know how to manage it. You know how to be a good asset manager. So that's key. Student housing is very different than multifamily, but it's been an amazing asset class for us as well. We have both in our portfolio. I started, as I mentioned, renting to college students 22 years ago now, or 23 years ago now. So I've always enjoyed renting to college students. It's a totally different demographic. But as I look at what we're doing today at a more institutional level, it's really interesting because you have very low delinquency because parents have saved money or they're getting student loans, and parents are guaranteeing those leases. So your delinquency is low. It's the other thing that's interesting is we've seen actually more rent growth in the student housing market than conventional. I mean, we all know that we've had crazy rent growth in the last several years, but this year in particular, you're seeing a little bit of softening in rent growth in certain markets that have been really heated. But in student housing, rents keep growing, and it's been just a truly phenomenal asset class for us. But it's hard work. It's completely different than multifamily. So it's not for everybody, and most of the conventional guys that move into student housing definitely fail if they don't have the expertise because it's totally different.
Let's talk about that a little bit more because I know a lot of syndicators, they're moving into student housing. And what are the main differences since you have done multiple things, first of all, land development, design, and then multifamily, now student housing. So if you have to put everything in one order, and then you're still leaning for the student housing at this point, so what are the factors, the key factors there that differentiate that from the rest of the asset classes, and how you think it's more beneficial?
So, for me, it's not one or the other. That's why we do both. But it's a great hedge to have a balanced portfolio with student housing exposure. So, student housing is typically recession resistant. If there's a softness in the economy, people go back to school or they stay in school longer because there's not as many jobs. And in 2008 and 9 were phenomenal record years for student housing. During COVID, in fact, student housing grew as an asset class. We realized that students didn't want to be in their parents' basement studying virtually. They actually stayed on campus during housing and continued to pay rent.
I didn't mean to talk over you, but I think it's an interesting fact to know that students were in the dorms, but I thought, not dorms, in the student housing, but I heard that most of the students were sent home due to COVID, and then people were suffering a little bit at that time.
So some did, but so it was an initial shock. Everybody in my industry was like, oh my God, what's going to happen? The schools are closing down, classes are going virtual. Everybody's going to go home and they're going to stop paying rent. Well, that didn't happen. Sure, some went home. They just preferred to be at home. But because we have private off-campus housing with their own bedrooms and bathrooms and outdoor space and just a lot of room versus being in a dorm room with another roommate, that's not what we do. So a lot of those students chose to stay in those beautiful apartments to be with their friends and to go to school as a hybrid or totally virtual, depending on the school. They didn't want to go home and sit in their with their parents, and it's no wonder why. So the ones that went home, or the ones, of course, that stayed, they continued to pay rent because parents guaranteed the rent. And that's their obligation. So we still, delinquency spiked up a little bit during COVID, but nowhere near what it did with conventional multifamily. So we like it from that standpoint. It's proven itself to be an amazing performing recession-resistant asset class. But it's very different to operate. You really have to understand, a student demographic, because I almost equate it to like senior living, assisted living. It's a business that happens to involve real estate. But it's not just real estate. I mean, you have to provide them an experience. You have to understand how they think. You have to understand what's important to them. And that changes. Case in point, people used to buy cable packages and give all the students, cable. Well, students don't do cable. All they want is internet. They want to stream everything. So cable has come and gone. It used to be that all these different amenities were really important to them. But at the end of the day, there's been a shift, and now what's important to them is really good high-speed internet, a good gym. But the movie theaters and all these other amenities, the kids aren't using them. So it's a dynamic industry that you constantly have to watch. The obvious, you have a short window to lease up the units. So as you're getting ready for the next season, it used to be that you wouldn't start leasing until after the new year. Now we're starting to lease even earlier. We're starting to lease in October, November, and pre-leasing for the following year. So you have to know what you're doing. You have to know how to do that. You have to be an operator. And if the guys that are coming in from a conventional standpoint, they don't know all those dynamics, and that's where they get in trouble. So
yeah, you said one thing very good: experience. And experience is the number one thing in today's generation. I would say the students, because it's a new generation, new mindset. They're much more aware what they want in their lives. It's not like you and me age group, like we were totally different mindset. So these days people the kids are totally different. They are just living for experience. And if you're creating that experience for them, what they're looking for, you're basically giving them what they want. And that generates a more, I would say, the traffic, a more rental base for you. And this experience, I say, is applicable to any asset class, not just to student housing.
Yeah.
It goes for the multifamily as well. And the operators who are not savvy enough that, provide that experience what people are looking for, which is always actually the case, because if the experience is not good, people are going to come back to you. So, how did that change for you? You've been in the student housing for a while, right? So like you were giving the example of the cable versus like streaming services. Many more apps are available now. The way students operating is totally different. So how did that change the trajectory for you, how to manage or operate your student housing?
So, of course, I had a basic understanding of sort of the student demographic and how they rent and parental guarantees and so on and so forth that I've just built over the last 23 years. But when you get into an institutional level and you're buying and owning purpose-built assets, it is different. It's at a higher level of sophistication. So I think one of the smartest things I did is I brought on an operator that was a property management group, and I partnered with them. So I partnered with the principal of the group. He comes in, they invest, and that's been a game changer because they're an equity holder. And my friend who's been in the business for 25 years is an absolute expert. Additionally, what happened is the number two guy from that company didn't want to be in property management. He wanted to be on ownership. So he came to work for me. So now we have another person on my team that's got years of student housing expertise. So you have to surround yourself with people that have the experience. I just got back from the Student Housing National Conference in Austin just a couple of weeks ago. So you have to go and you have to learn those trends. You got to stay up with those trends and be ready to pivot. I think one of the most interesting things about the student housing business, it's super dynamic. It is different from one MSA, one market, one school next. The type of asset that you're buying could be very different from a different type of asset. And then I think you'll appreciate this one. Your demographic could be vastly different. So we have what I'd call a bunch of rich white kids in our asset in Auburn. They're a different sort of clientele than our asset in University of Florida, which happens to be primarily international students. We have probably 70% Indian, maybe 20% Chinese, and then, a mixing of just your average, white kids. So the Indian kids have different preferences, the way they live, their expectations than the Chinese. So those are all these nuances. You have to be very responsive and understand who they are to give them that experience that they're looking for. So,
yeah. Thanks for saying that. That was my next question, because I was a professor too in my previous life. So I understand, there's so much diverse background in students too. They come from all over the world, and then they are looking for different experience. They have different backgrounds. They have different interests. So the question that I was going to ask you, you have answered already. How do you manage those priorities? Because it might not be applicable to everybody, whatever you're trying to do. Do you do something different for the different people, or do you offer kind of pick and choose kind of buffet kind of menu for people so that they enjoy that?
Sure. For if the demographic of our asset is fairly homogenous, then that's relatively easy. Our asset in the University of Florida, it's a little bit more complicated because, there's a certain event that we'll have for the Indian students. The food, the experience might be a little bit different than what we're going to do, with our Auburn asset or University of Arkansas. So you have to cater to those residents. The other thing that we've noticed, specifically with the international students, when they come in to potentially lease from you, they want to see one of their own, so to speak, working there. So having the same sort of demographic behind the desk as your leasing agent as you are just gives you that comfort. You walk in and then you see an Indian student that's working there. You can speak the language, there's a comfort. So we've noticed that doing that is a big difference.
Great. That's super awesome to know that. And earlier you compared the student housing with the senior living. Because I'm assuming, please correct me if I'm wrong, that you are providing the similar amenities to the students. And you mentioned food earlier as well. So food, entertainment, everything. So that kind of differs you from the multifamily asset class, right? Because you're providing a little bit more.
Yeah, we're not really providing the food, but when I say we have food, it's more of the resident events. We're going to have pizza night. We're going to have, we're movie night. We're going to, instead of popcorn, we might have X, Y, Z, depending on the demographic. So that's primarily what I mean. So it is a lot of events. We're trying to build a culture. So that's really kind of how it pertains maybe just to senior living, where you're creating a lifestyle and events and bingo and whatever. I don't know senior living, but whatever they do in senior living. So yeah, that's the part that is similar. So it's an active sort of business.
That's awesome. So let's shift gears. Our topic today is how to vet a sponsor. What should a passive investor look in a sponsor? So I wanted to hear your viewpoint, because since you have tons of experience and you've been LP in multiple deals yourself as well. So what do you look for in a sponsor?
Sure. And I'm going to try to be respectful of I guess some newer sponsors and maybe what I call, it's going to have a negative connotation, but disjointed syndication groups, right? So I've been doing it a long time, obviously, and I've always invested in other people's deals as well as my own. So if I don't have a deal, I've been in a fortunate position. I've made a lot of cash. I want to put it to work. I don't want cash just sitting in the bank. I always want to, keep it working, especially for the obvious tax advantages that we have with real estate as a GP or an LP. But through my years of investing in others as well as myself, I've noticed, a couple of things in the last 4 or 5 years that I think you and I both see is that newer sponsors, they don't have enough experience. They may have tremendous experience, being in the corporate world, but not all of that is transferable to what we do. So I think, you have to be selective with who you're going to invest in. The other thing I've noticed that a lot of sponsors are not full-time. I mean, I would never personally invest in a real estate deal where the sponsorship team is not full-time. And I don't mean just one guy full-time. I mean the whole team has to be living and breathing every day full-time in the business. And I say that because I have the option, right? I know enough good sponsors that are dedicated, focused, and it's a real business. So if you're going to invest with Ashland and I go out and I get hit by a car tomorrow, God forbid, there's 7, 8 of us behind me that are full-time that would just, the business would continue. My estate would be the benefactor, but the business would continue. So, investing in like 3 guys that are maybe, corporate guys, and they're doing this on the side and it's disjointed. There's not one unified company vision and management pushing that business plan. I'm just not sure why investors would do that. So that's my bias, my personal bias. I think you've got to find people full-time that are dedicated, have the experience, and that are really managing those assets on a daily basis. There's this kind of common thread that we hear about in our business. Well, I'll be on the weekly or bi-weekly call. I think a lot of sponsors get delusional thinking that if I talk to my property manager once, twice, 3 times, 4 times a month, that I'm gonna get the report, things look okay, and it's fine. That's what you do. It's not what we do, and I've never been comfortable. Maybe that's why I'm a bit of a control freak, is that we want to find the problem before the problem actually exists. And the only way to do that is daily communication. We're on the phone with the on-site team, with our leasing manager, the property manager, the maintenance staff, almost on a daily basis, so that we understand what's happening in real time and we give them direction and feedback and support. That's the only way to do it, in my opinion.
I agree with you 100%, because that's very important, because the asset management piece that you brought in, that's very, very critical, because anybody can buy a property, doesn't matter what background you come from. You can buy a property, you can close the property, you can put it on social media. Hey, I closed the property. What next now? And that's the piece is missing for most of them, because the actual management, and it's not like that the property management care that much as you care for your own property. So that feeling, that sentiment has to be there in order to take the deal to the completion. And I think that's what we did on our last deal together, right, Alex? So just wanted to vouch for that. Wanted to highlight that we did awesome in 17 months.
Thank you for the plug. No, it was great. It's great partnership and a great asset. And to be honest, I regret that we sold.
Right, that was a really good property. So now let's talk about a little bit about the investment strategy. Because as an LP or a passive investor, you need to understand what the investment strategy, what the theory is behind the deal. What kind of questions LP should be asking the GP, because a lot of LPs are like very new, they are raw, they're coming from an IT background, or they're doctors or engineers, do not completely understand what's going on in the field. They just look at 30% return or 100%, double-digit return or whatever. That's what I'm getting back. I'm okay with that.
Yeah, 100%. Well, I think if I was an LP, and I am, an LP often when we don't have our own deals, I start with, of course, the sponsor. You have to understand the sponsor's background, their team. Are they full-time? All the stuff that we just talked about. Assuming you check that box and it's the right sponsor profile, then you start with the market. Say, what is compelling about Phoenix? What's compelling about Des Moines, Iowa, or Fayetteville, Arkansas, et cetera. You have to understand that, and you have to ask as an LP for them to communicate what metrics are they using, why is the opportunity compelling, right? So you start there, and then you get down to the asset level and all the different details. So some of the things that I would be asking: how did you find the deal? Is it off market? Is it on market? What's the business plan, and what is the risk associated with the business plan? Some deals are going to be high risk because they have, you're going to be doing a heavy value add. You're going to be, taking it down to the studs or whatever you're doing. So you as an LP have to understand the risk, and the sponsor needs to be honest with you with what is the risk and what is the upside associated. Is it worth it? Is it an asymmetric risk profile or not? So, if it is a heavy value add, are you putting on floating rate debt? Is it bridge debt? Is it permanent financing? That today is critical. And I will tell you that today we're not doing that. We're looking for deals that we can walk into cash flow day one. We could put permanent financing, typically agency or bank debt. We have flexible prepay because we don't know when we're going to need to sell. And if we can't sell because the prepayment is so prohibitive, that's a challenge. So these are just, random things that, of course, I always ask and that LP investors need to know. Another metric is, does the deal rely on heavy rent growth, right? Is that reasonable given the market? And what are the dynamics driving that? Is employment growing? What type of employment drivers are there? So, I think a lot of guys are going to be very, or have been at least, and I think some of them still are, very aggressive on rent growth assumptions, very aggressive on OpEx costs. It's also amazing to me that professional syndicators won't spend $1,500, $2,000 to get a professional tax study, to hire a firm that does nothing but assess what your tax impacts are going to be during your hold. We always do it. I want to know base case, worst case, worst case, base case, best case, right? You have three sort of predictions on where the tax is. What do we put in our underwriting? Worst case, right? But a lot of guys don't do that. They'll guess. They'll look at the county website and they'll try to calculate the millage rate themselves, and they don't factor in a lot of the other dynamics that a specialist would. What else? Getting third-party inspections by specialists. Like, have you done the proper due diligence? Explain to me what your due diligence process is. And if a sponsor can't explain to you in high level of detail all the different boxes they check in their due diligence, that's a red flag. So I would be asking what the due diligence process looks like. There's a ton. I could go on and on.
There's a lot of things. I know I can record another show with you on this one. But the other thing is the alignment of interest. That's very important too. Because if there's no alignment, it's not going to work out for you.
Absolutely. And a sponsor needs to explain to their investors what that alignment of interest looks like.
Mm-hmm.
There's some sponsors that have a very low preferred return, so they're going to be quickly making money. We believe that the deal has got to do very well for us to earn any kind of compensation. So we have typically a higher hurdle rate. I invest in every single deal significantly. My family does, my close friends. So we're stakeholders. We're aligned. We all have skin in the game, and your LPs need to understand those dynamics.
Yeah, it's very important to have the skin in the game. Otherwise, the level of interest is not the same. Let me put it this way. And then every LP should make sure that whosoever they're investing with, that the GP has some skin in the game. It's not just like they are 100% putting all the money in. And the other thing is the communication and expenses that they should be questioning on when they look at the deck. It's very important how the GPs are communicating with the LPs, or how often, because frequency is important too, to have them on the same page, right? What do you think about that?
Oh, absolutely. Communication is everything, good or bad, right? And what we do, and which is not what everybody does, and I think more is better, is communicate on a monthly basis with a full report, which is what we do, and then distribute capital on a quarterly basis. Mm-hmm. That's a very reasonable cadence. And communicate the bad. Every project, no matter how successful, is going to have some bumps in the road. There's no reason to hide them. Say, hey, we had more move outs this month than anticipated. We had some expenses that ran higher, right? You got to explain to your investors what those bumps in the road are, and as importantly, what the plan is to get the wheels back on the tracks. And how do we make up for this? So if we didn't do as well in one part of the business plan, we're going to have to make up for it in another part of the business plan. And that's why it goes back to that daily asset management, so that you can see it, you can see the problem, you could pivot immediately. If you're finding out about it in a report, that means it's already happened and it's too late. So you have to be all over it.
Yeah, and it's very important, to communicate whatever is happening, because the LPs or the limited partner has to understand that too, because this is a time frame that we are in. Let's say the deal is for 5 years. So we started year one. So if anything can happen between now and till we exit the property. So there's going to be a little bit kind of roller coaster, you can say, kind of ride, little bit ups and downs, like you said. So it's not going to be always that you're going to be on the positive end. But as long as the jockey, the sponsor is managing it correctly and they have a strong track record, it's a good thing. It's nothing bad, because in the end, if you're exiting with the flying colors, it's all good. So in the middle, you're managing it properly. That's what shows your strength. I love that. That's super awesome. So I know we are out of time, but I want to ask you one more question before we go. So in your crystal ball, see for the next couple of years?
I think the next couple of years are going to be interesting and choppy, but with that comes opportunity. So there's a lot of guys that are pencils down and they're not doing anything. And I'm actually happy for that, because there's more opportunities. And then, of course, the unfortunate part of our business is going to be guys that are getting in trouble. We have a deal right now that we're rescuing, so to speak, a couple of young sponsors, and we're buying it at a great basis, but they have to sell. They have floating rate bridge debt at a very high interest rate, and they were poorly capitalized and could not execute their business plan. So we're buying it from them. So more of that is to come. And if you're properly prepared and you're talking to your investors about those opportunities, and all of us collectively are getting ready, we'll have some great opportunities. Back to what we started with beginning of the show, the fundamentals are still very, very good. We need housing. We need affordable housing, multifamily, student housing, single family, BTR, built for rent. These are all great asset classes. So you just have to get the right debt, the right deal, the right location, and manage it right. And it's a great investment. I mean, most of my net worth is in real estate, and it's going to continue to be in real estate.
Yeah, and the right operator, right? When you said the management, the right operator, the right sponsor, always bet on the jockey, not the horse. If the jockey is good, they can turn the bad deal into a good deal. So share one golden nugget with my audience.
Golden nugget. Oh man, what is the golden nugget? All right, I'll give you a golden nugget that's non-real estate related.
Yes.
And that is, I've started a nutrition and fitness plan with a longevity doctor that I know, and it has been off the charts. So I'm taking a whole bunch of vitamins. I'm working out with a personal trainer 3 days a week, and I've never felt better. So I know everybody in our business gets, bogged down in the weeds, but if you don't stop and take care of your mind, your body, and feel great, you're never going to perform optimally in your business or for your family, for that matter. So I have an 8-year-old, so I've got to stay healthy, energetic, and fit to keep up with my little man. That's the nugget I got.
I love it. Your mind, body, and soul has to be in sync to do anything. And your inside reflects your outside. We have to remember that. So we have to stay in sync. So this brings us to our rapid fire round. I'm going to ask you 5 questions. You're going to answer in 1 word or 1 sentence only. Ready?
Okay. I'm ready.
Right. So the first question is, what is one of the most important things that you have learned in your life? And how did your life change after learning it?
I think it's people. It goes back to your comment about choosing the right jockey. You have to choose the right jockey in life and in business. So whether that's, a life partner, wife, whether it's a best friend, business partner, you got to choose the right person.
I love it. Life is all about choices, right? The choice that you're going to make in the present going to decide your future. Love it. What is one best book that you have read or recommend to my audience?
So I'm embarrassed to say that I'm listening to more podcasts and books online than reading. But one stands out from a coaching group that I was involved in called Strategic Coach. So a prop to Dan Sullivan, but the book Who, Not How is a really good book that helps you really kind of think differently about scaling your business, obviously around who, the kind of people that you need around you. If you get those around you, the what will come easily.
That's true. I have that book too. I read it too. Yeah, I love it. I love it because it changes your perspective too a little bit. Because not one person can do everything. You have to delegate at some point to scale, which is awesome. In one word, what does life mean to you?
Joy.
Awesome. What is your biggest passion?
My biggest passion is family. I mean, family and everything that, like, living, right? That's my biggest passion, and work is part of that. Fitness is part of that, and my life with my family, of course, and then philanthropy. So it's not one thing. I have to have a balanced life, and then I feel like I'm living.
I like that. We didn't get to talk about your philanthropy. Maybe next we're going to do another episode with you. If you could turn back in time and talk to your younger self, what would that be and why?
I'd probably tell myself to have more patience, but on the other hand, take more risk. I've always been pretty conservative, and it's worked out great for me. But sometimes I think, man, had I pivoted and followed that one idea, that, wow, it could have been pretty amazing. So, I probably would have taken a little more risk.
We all say that. We get wiser as we age. I'm sorry to say that. So how can people reach out to you?
You can find me on our website, which is ashlandcapitalfund.com, or you can email me direct at Alex, which is spelled oddly, ALIX, at ashlandcapitalfund.com.
Thanks, Alex. Oh my God, I had a great time on the show today.
Me too. Thank you, Vinki.